Welcome to Northwest Florida News and Real Estate. I'm your host, HomeBot. This podcast is curated by Lars Rygaard and his team of real estate agents. In today's episode, we'll dive into one of the most valuable tools for real estate investors in Northwest Florida, the 1031 like-kind exchange. If you're looking to maximize your investment potential, defer capital gains taxes, and strategically grow your portfolio, this episode is essential information for you. And our specialized real estate team is ready to guide you through your exchange. So, what exactly is a 1031 exchange? Let's start there. A 1031 like-kind exchange is a tax deferral strategy that allows investors to sell a property and reinvest the proceeds into another similar property, without immediately paying capital gains taxes on the sale. The name comes from Section 1031 of the IRS Code, which outlines the rules for these exchanges. The key benefit here is that by deferring taxes, investors can preserve more capital to reinvest in new properties. This is particularly powerful in a market like Northwest Florida, where property values have been steadily rising, and capital gains taxes can become a major consideration. Now, the term like-kind might sound a little confusing at first, but it's actually quite simple. Like-kind doesn't mean the properties have to be identical. It just means that both properties must be of the same type or nature. For example, you can exchange a commercial property for a residential rental or even a piece of raw land for a shopping center, as long as both properties are held for investment purposes. This provides investors with a great deal of flexibility, which is a huge advantage in a rapidly growing real estate market like the one we see in Northwest Florida. So, why would an investor choose to use a 1031 exchange? Well, the first and most obvious reason is tax deferral. If you've ever sold a property and faced the reality of capital gains taxes, you know how much that can impact your bottom line. A 1031 exchange allows you to keep your profits working for you, instead of giving a chunk of them to the IRS. With Northwest Florida's strong real estate market, investors can sell their properties, avoid paying those hefty capital gains taxes, and reinvest all the proceeds into a new property that could appreciate even further. But tax deferral isn't the only benefit. A 1031 exchange also allows for portfolio diversification. Let's say you're holding a rental property in Pensacola, but you're looking to get into commercial real estate or maybe even raw land for development. With a 1031 exchange, you can sell your current property and reinvest in different types of real estate without paying taxes on the sale. This flexibility helps investors spread their risk across various property types, ultimately creating a more balanced and potentially more profitable portfolio. And it doesn't stop there. A 1031 exchange can also increase your cash flow. For example, let's say you're holding a small single-family rental, but you've been eyeing a multi-family property in Destin. By selling your smaller property and reinvesting the proceeds into a larger multi-family unit, you could significantly increase your rental income and overall cash flow. Plus, by deferring taxes, you're able to reinvest a larger sum of money, which means your potential returns could be even greater. Another major advantage of a 1031 exchange is avoiding depreciation recapture. Over the years, you may have taken depreciation deductions on your property, which is essentially a way to reduce your taxable income. However, when you sell the property, the IRS may require you to pay taxes on that depreciation. If you use a 1031 exchange, you can defer the depreciation recapture taxes as well. This can result in significant savings, particularly for investors who have owned their properties for a long time and have taken large depreciation deductions. Now, you might be wondering, how exactly does the 1031 exchange process work? It's a little more involved than just selling and buying property, so let's break it down step by step. First, you need to sell your relinquished property. This is the property you're giving up. Once the sale closes, you begin the exchange process. Importantly, the IRS requires that you don't directly receive any proceeds from the sale. Instead, you'll need to work with a qualified intermediary. This is a neutral third party who will hold the proceeds from your sale in escrow until you're ready to reinvest them in a new property. After you've sold your property, the next step is identifying replacement properties. You have 45 days from the closing date of your relinquished property to identify one or more replacement properties. This is where things can get a little tricky. The IRS has strict rules about what qualifies as an identified property. For example, you can identify up to 3 properties regardless of their value, or you can identify more than 3 as long as their total value doesn't exceed 200% of the value of the property you just sold. But be careful. If you don't identify the properties within the 45-day window, you risk disqualifying the exchange. Once you've identified your replacement property or properties, the next step is to close on them. You must complete the purchase of the replacement property within 180 days of the sale of your relinquished property. This is a hard deadline, and there are no extensions, so it's important to stay on top of your timeline. One thing to keep in mind is that the replacement property must be of equal or greater value than the property you're selling. This doesn't mean that the properties have to be the same price, but you must reinvest the full proceeds into the new property, or you may face taxes on any leftover funds. This is often referred to as boot, and it could trigger a tax liability. Once you've completed the exchange and closed on your new property, the final step is filing your taxes. You'll need to report the exchange to the IRS using Form 80E-34, which outlines the details of your 1031 exchange and ensures that you're in compliance with all IRS rules. Now, let's take a quick look at the timeline for a 1031 exchange, starting from the day your relinquished property closes escrow. Day 1 is when the relinquished property closes escrow. From that moment, you have 45 days to identify your replacement property. Then, you have 180 days from the closing of your relinquished property to close on the replacement property. This means the entire exchange process must be completed within 180 days. In summary, a 1031 exchange is a powerful tool that allows real estate investors to defer capital gains taxes while reinvesting in new properties. Whether you're looking to diversify your portfolio, increase cash flow, or take advantage of market opportunities in Northwest Florida, a 1031 exchange can help you achieve your investment goals without the immediate tax burden. However, the process is time-sensitive and requires careful planning. It's always a good idea to consult with a professional who understands the nuances of 1031 exchanges and can help guide you through the process. Thanks for listening to today's episode of Northwest Florida News and Real Estate. I'm your host, HomeBot, and this podcast is curated by Lars Rygaard and his team of real estate agents. Be sure to subscribe for more insights into real estate, news, and everything happening in Northwest Florida. Until next time, happy investing!